Have you ever wondered why your friends from overseas seem to be doing way better financially? Maybe they are constantly traveling, or their house seems nicer, maybe they drive a nicer car. Well, it might have something to do with how you, as someone living in Europe or Asia, handles his or her money compared to someone living in the United States. And I actually came across a very interesting chart the other day that reveals a lot about the American and European investing psyche. So today we'll take a closer look at this chart, confront the realities of European investing, discuss what's possibly wrong with European investors, and highlight some of the ramifications of it for the wealth accumulation of both Europeans and Americans and everyone else too. So without further ado, let's get started. All right, hi everyone, my name is René Solomon and I'm just going to show you the chart that I was talking about in the introduction of the video. So here it is. And what you can see here is basically the percentage of household assets that is invested in equities, so in stocks. And what stands out immediately is the major discrepancy between the percentage of financial assets invested in stocks in the United States compared to the European area. And in this graph, it is further distinguished between the Euro area, so where the Euro is the main currency, and the United Kingdom. And basically, it becomes very clear that households in Europe own much fewer stocks than their American counterparts. And after I came across this chart, I actually did some further research and I came across the following bar chart from Statista that is from 2021. In this chart, we can basically see the stock ownership among different European countries, and we can see that even within Europe and the EU, there are major differences. So Germany is towards the very bottom of this chart actually, with a stock ownership rate of around 11%, whereas other countries like Estonia or Finland post much higher stock ownership rates, north of 50% in the case of Estonia. And if I may just get back to the title of this video, why is this problematic? Well, let me explain. What you might want to do is you might want to head to the landing page of the mentorship program that I offer, because on the landing page, I share the following framework that distinguishes between 4 different types of people that I come across in my social circles. So we've got the generation YOLO, so you only live once, the savers, the wannabe investors, and the hopeless cases. And what all of these groups have in common is that they are doing something wrong. And I won't get into the details here, but if we may just focus on the savers here. Europeans as a group tend to be very good savers, tend to have at least higher savings rates than US citizens on average. However, as highlighted, financially they are oftentimes doing much poorer. And that's because they are good savers, but they are poor investors. What you have to realize is that the asset that is often perceived as the least risky one, so that would be cash, is actually the most risky asset if you take a longer term view. I often like to show people the following chart that compares the real returns of various asset classes over the very long term. And what you can see here is that cash is basically the only asset class in this chart that is yielding a negative real return. So what this here highlights is that your biggest risk financially is actually not to invest. Having large sums of money in your bank account for a long period of time, that's the definition of risk, because that money is ultimately going to be less worth in the future. And that's because of inflation, because inflation might be one of the most cruel taxes in the world. I say cruel because it's invisible. It doesn't show up on your bank account, but it still erodes the purchasing power of your money over time. And in this context, I may also highlight the following illustration that shows that saving obviously will grow your wealth over time. If you put away, say, 30% of your income every single month, well, you will get wealthier. But saving will only grow your wealth linearly, while investing your hard-earned money will grow your wealth exponentially. And if we get back to risk, what is worth understanding is that stocks are not inherently risky. How risky stocks actually are depends on your holding period. And obviously, the further you can extend your holding period, the less risky stocks will actually become. And at some point, they are almost not risky at all. This illustration here, for example, shows the odds of a positive return depending on your holding period. And as you can see, if you can extend your holding period to 20 years or more, the chances of you actually losing money goes to 0, at least historically over the last 130 years. In the United States. And just to further back up my claim that investing is incredibly important if you want to build wealth, let me show you another interesting statistic that I'm aware of as someone living in Germany. So what you have to realize that Germany is obviously quite a strong economy, even though it may be on the decline a little bit, which means that the average and the mean income per capita is fairly high compared to other European nations. And this is visualized in the following chart that I'm going to show you on screen right now that compares the median equivalent income PPP of Germany compared to France, Italy, and Spain. However, if we now look at another statistic from the same analysis, we can see that the net worth per capita in Germany is actually lower, which should be somewhat counterintuitive considering the higher level of income of Germans. Well, and the reason is the same as why Europeans tend to do worse financially than US citizens. Well, Germans tend to be good savers, but they are terrible investors, not because they are terrible at picking stocks, but rather because they are oftentimes not investing at all. So while people in France, Spain, and Italy may actually invest in productive assets like real estate, Germans tend to have a fairly low home ownership rate, which is also referenced in the study the statistics and the charts are taken from. So let me just quote from the paper here. On the first point, the level of household wealth is connected to the ownership of the main residence. The rate is 44% in Germany, probably due to a primary role of social housing in this country, compared to 55%, 69%, and 83% in France, Italy, and Spain, respectively. All right, this brings me to the last chapter of this video. So why are Europeans so cautious? Why are so few people in Europe actually owning stocks? And what can we maybe do about this? Well, I think there are a couple of reasons for this, and I want to highlight two here. Well, first of all, I would argue that there's a possible connection between home country bias, European stock market performance, and the lower stock ownership rate that we can encounter in Europe. And here's how that works. First of all, not everyone here may be familiar with the term home country bias. So what does this term actually stand for? Well, it means that people tend to favor investments that they are familiar with, leading to them actually overweighting stocks from their home domicile. And as this chart here shows, historically, US stocks have actually outperformed the European stock market by quite a large margin. So what I looked at here is the performance of the S&P 500 versus the Stocks 600 index over the last, ballpark 15 years. And similarly, the S&P also outperformed the Stocks 50 index between 2008 and today. And due to the fact that people favor investments in their home country, this poor, or maybe I should say relatively poor stock performance may discourage some people in the European area, because the past performance may be seen as an indicator for future performance, which obviously is not necessarily true. And due to the poor stock performance, people may also place less focus and emphasis on stocks as an asset class, which may make people less knowledgeable when it comes to the stock market and how to invest successfully. Which brings me to the second explanation for the phenomenon that I'm addressing in this video. I think overall we also simply have no investing culture here in Europe and in Germany specifically. So first of all, I think there is little awareness among the population as a whole. This is not something that is taught in school and not something your parents talk to you about, in many families at least. Then generally speaking, I would argue that we don't have a shareholder-friendly culture here among board members and also management executive teams. So in my most recent video on the events unfolding at Endo, for example, I was highlighting that one of the board members on Twitter actually outlined that he believes investing in the company that he is a board member of can be considered speculation, which is completely absurd in my opinion, and which is something that I would like to believe is much rarer in the United States. And then finally, I would also argue that the regulatory framework and also the tax system in Europe and in Germany specifically is not particularly stock friendly, encouraging people to own stocks. So how do we change that? Well, we need to spread awareness. You might want to start by sharing this video with your friends that haven't started investing yet. And then on top of that, we also need to spread financial education, of course, because you can only invest successfully if you actually understand what you are doing, because if you do not, you will inevitably make irrational emotional decisions, which will lead to the poor outcomes that some people may have experienced, and then they will never invest again, which might be one of the biggest mistakes they can ever make in their life, at least when it comes to their finances. Knowledge gives you confidence, and that is something you should work on. Every single one of us, I myself included, keep learning more about stocks, the stock market, investing in general, and you will do very well financially over the long term. I can almost promise you that. And with that, I'll wrap it up here. Have a great day. Take care.